Good afternoon, everybody. Welcome to the Trader Merlin Show. It is your Friday edition. That means it's the trading week wrap-up, although we're doing things slightly different today. Normally, we would have Bill on for a FOMC statement announcement. That's usually on like a Wednesday or Thursday, but because I took Wednesday and Thursday off, conveniently for some of the best trading days of the year, I'm going to have him on today. So before I do that, a big cheers to everybody out there. I know that Big Eb is driving today, so Big Eb, keep your hands on the wheel. Don't be looking at a screen. But shout out to you for this wonderful bottle of bourbon that you bought me. So cheers to all. Happy Friday. Big Eb bought me a 10-year-old bottle of Henry McKenna single barrel bottled in bond. Absolutely delicious. The way that my dating life's going, I might finish this bottle this weekend. Big Ed, thanks again. Drive carefully, my friend. Hope you have a great weekend. Anyway, let's dive into our topic du jour. Obviously, we had Jerome Powell on Wednesday come out with a very predictable, no-shocker rate announcement, and I wanted to bring Bill on to get a sense as to what he thought about the statements that was made by Jerome Powell. Were there any changes? Did you see anything that was wildly out of line, or was this just a snooze fest?
I wish I could say more exciting. It really was a snooze fest. I mean, when you look at and people like to microanalyze every adjective and every adverb, and literally in one of the statements talking about second half growth this year, they went from talking about robust growth to more moderate growth.
Right.
I mean, that was newsworthy in this press conference. He also did a very good job of staying on script, and that's kind of hard for him. Mm-hmm. I mean, let's be honest. He knows he's under one heck of a microscope right now. And he played it very close to the vest. There was nothing ad hoc said. He's capable of moving the markets when he does that. And this was just such a boring snooze fest.
Yeah.
What's interesting to me, though, and we were talking briefly before, is, what a difference one day's worth of economic data can make.
Yeah.
When we looked at yesterday, and the big news yesterday was the fact that there was dissenting votes. Traditionally, the Fed likes unanimity. They strive for it. And we didn't get that this time.
There were two dissented, right?
Exactly. Michaela Bauman and Wallace.
Yeah.
Now, these are the two Trump appointees. So and Wallace is
Well,
really
hold on. To be fair, Powell is a Trump appointee.
Absolutely. Absolutely. And most people forget that. And Trump forgot that last week.
Hey, Trump doesn't care. If you don't do what I want, then I don't like you. That's what Trump is.
Exactly. So we had two dissenting votes, and the general feeling was that was just a political statement made for the benefit of the president. But Wallace is the leading candidate to be the next FOMC chairman. So, the fact that he was willing to get up there and dissent not only made a statement to Trump, it made a statement to the market.
Yeah.
But again, it's majority rules. So we had 2 out of 12 were dissenting votes. It passed without a problem. But that part was, a little bit of drama at the Fed, if you will.
Let me ask you real quick. You said 2 out of 12. It's kind of interesting that there are 12. So, you could have a tie. But let's say that we had 7 that said, hey, let's lower rates, and 5 that said, let's keep them the same. Does Powell have the power to go, well, it's 7-5. I'm going to go with the 5, or does he have to go with the majority?
No. So at first blush, Powell is just one of the 12 votes. So he has one like any other. The only extra power he has is in the event of a tie, which he could have been causing through his vote. But in the event of a tie, he gets an extra tie-breaking vote. So he does have some. Where the chairman really comes into play is the chairperson really sets the tone for how the committees are going to operate.
Right.
And not to make it too much of a history lesson, but we've talked at length about, remember back to the Volcker days, he didn't like that the markets got information.
Yep.
So when the Fed met, they never told us what they decided to do. It would sometimes take us days and weeks to figure out what the Fed was doing. And then Greenspan comes along. He introduces a little bit more exposure. Bernanke. So the Fed chairman, they kind of reflect their personality in the meeting, or the meetings take on their personality. But more importantly, they're just one of 12 votes unless a tiebreaker is needed.
I've always wondered that because, you hear so much about the power of Powell, and it's like, hey, if everyone votes to lower, can he just go, no, you know what? I love your opinion and all, but I'm the guy, I'm the chairman, I do what I want. So interesting. So he has to go with the majority rules.
Yep. And remember, all of this is public knowledge. We get the actual notes from the meetings 30 days later.
Right.
So we even get to know the dialogue. So the notes from this meeting in 29 days could prove rather interesting
Yeah.
when these dissenting votes are cast.
Now, okay, I'm gonna play devil's advocate here because,
Okay.
well, it's just I know that stuff is manipulated. So yes, we get the FOMC meeting minutes in 29 days, and yes, there should be some good juicy stuff in there. And I'm pretty sure you don't know the answer to this, but to what extent is stuff redacted from that? We're like, you know what, let's not let that go out, because it almost feels like this is just a propaganda piece to have the FOMC meeting minutes, because they can really put whatever they want to in there to steer the narrative, for the next meeting. And I don't know. I don't know whether I trust that meeting minutes or not.
I understand your concern. From a realistic point of view, I think what's more likely to happen is these members know full well that obviously this is all being copied.
Yeah.
I think it's more important what happens in the meetings before the meeting. What are the discussions that happen before the stenographer comes in? If you're going to be stenographed and the whole world is going to be paying attention,
Yeah.
I think you act accordingly. I think the real issue is what happens in the meeting before the meeting. What's the discussion before the stenographer comes in?
No, man. Great stuff. So I did not get a chance to watch the press conference. I've been just the last couple of days have just been absolutely chaotic for me. Was there a grilling from the media regards to President Trump's call for resignation and other members calling for Powell to resign? Because I would imagine that's going to – I could see Steve Leisman just hammering that one, just trying to get it in there.
The questions came up, but Powell has done a very good job, I think, from the beginning, kind of giving the one-word answers that the press hates.
Yeah, right.
A simple yes, no, I will, I won't. Would you step down? I won't.
Yeah.
That type of thing.
And he shouldn't.
I think, there's no need to elaborate further.
Yeah.
So no, I think there was two questions, but it was not a presiding factor. I want to throw out a possible scenario to you, and we didn't have this discussion beforehand, but President Trump is obviously not pleased with Powell right now.
Yep.
And it would not be unlike him to try and usurp some of Powell's power. And he's basically come to accept the fact that even though he did appoint him to the job, he can't fire him. And Powell's term will end in March. That's when his 4-year term will end.
Yep.
If you wanted to usurp some of Powell's power, what about announcing who you would make as the next Fed chairperson? Make that announcement now.
Yeah. Yeah,
I mean, who is for the next 5 months? Doesn't that make Powell a lame duck? Isn't the press going to be focused on what the new chairman's going to do? The heck with what the old chairman would do?
Yeah.
I mean, doesn't this almost put a de facto subversive Fed? I don't want to say subversive, a de facto Fed in place.
Yeah.
I wouldn't be surprised to see President Trump announce what his next nomination is going to be if his level of frustration with Powell gets much greater.
What do you think about when you look at Jerome Powell? I had a great talk track right there and completely skipped my thought. Dab nabbit. Oh man, I'm having a senior moment today. This McKenna, this Henry McKenna, some good stuff.
It's the bourbon. Go for it.
It'll come back to me. I forgot where I was going with my statement there, which is unfortunate because in my head I had this really interesting talk track going on about Jerome Powell. But I've lost my train of thought. Sorry about that one. There you go.
That's all right.
Question came through from Margaret. Have you met Jerome Powell? How many FOMC members have you met?
Chairman Powell, I have met in 2 meetings. I've never had anything close to a one-on-one, but I've been at one was a trade association meeting. The other was a meeting sponsored by BlackRock, in which he was a speaker and I was up on the podium, but that was as close as I got. So I never anything close to a one-to-one. Bernanke, actually, before he was where he was, he spent a lot of time in Lehman Brothers. He was a fairly common presence over at Lehman. So I had the chance to meet Bernanke, who honestly I was very impressed with. I mean, he was the smartest person in the room always, but he never let you know it.
Bernanke?
I was real Bernanke.
Yeah, I liked him as well.
I was real impressed. Yeah. And I wish I'd had the chance to meet Greenspan. Obviously, it can still happen, I guess, but never met Alan Greenspan, but I hear the same thing about him. Smartest person in the room, but him, you knew it. As soon as he opened his mouth, you knew he was the smartest person in the room. Bernanke was a little bit more subtle about it.
As we run through them, you've got, obviously, Volcker, Greenspan, Bernanke, Powell, Yellen. Is there one that you just go, they're the best? I know it's hard to say because you do some teaching. I don't want you to get you in trouble, but, is he one that you have preference?
Without question, Paul Volcker.
Yeah.
I have the greatest respect for Volcker because he had the courage to do what no other Fed chairman has had the courage to do and probably will never again. When Volcker was head of the Fed, they took such draconian actions. We talk about the Fed might raise rates by a quarter point in September.
Mm-hmm.
Well, under his administration back in October of 1980, in one meeting, they raised the Fed funds rate by 700 basis
Oh
points.
my God.
7% in one meeting.
Well,
Now,
hey, to be fair, Trump only wants to go down 300 basis points. So, I mean,
exactly.
hey,
That's
bring
nothing.
back
Right.
Volcker.
Exactly. Exactly. He remembers the Volcker
Yeah.
days. But remember, this is back when the Fed was not transparent. They didn't tell us what they'd done.
Right.
It literally took us months before the Fed funds rate dropped that 700 basis points, and the economy did finally get inflation under control because they had the courage to literally force the U.S. economy into a recession by raising rates so high as to force us into recession. And, to quote Warren Buffett, and I do this in my focus class, Buffett, like me, has the greatest respect. Buffett says to any corporation that survived 1980, they should elect a statue of Volcker in the lobby. And every employee should kind of genuflect to Paul Volcker on their way into work in the morning. Because it's only through his courage did the U.S. manage to sustain what could have been a much more uh, horrible situation in terms of that stagflation problem, which we could be coming up on again.
Yeah. Let's I want to go and bring up a couple of slides here. You sent me a couple, so I want to just talk about those real quick. Your first one shows the Fed easing, basically that tapering continuing. It looks great, honestly, for what's been happening since 2022. That curve has been getting lower and lower and lower. And what you're seeing there on that blue line is the total assets of the Fed. And I wonder if you could speak to what this chart means to you and what it might mean for the markets.
Yeah, so everyone is worried about inflation. The big quandary we're all stuck with now, as we know, is the economy strong or weak, or is inflation strong or weak? And depending on the answers to those two questions will dictate how the Fed is going to go. And this chart shows that the underlying cause of inflation, which is too much money, is being addressed. What that chart shows you is, if you look, this is a chart of the Fed's balance sheet. So during the pandemic, as we know, the Fed did quantitative easing where they created about $4.5 trillion of new cash and dumped it into our economy. And their balance sheet went up to about $8 trillion. The Fed continued to print and create more money. And until finally the Fed's balance sheet went up to $9 trillion.
Crazy.
Over $4 trillion of that was money they just injected during the pandemic. I mean, the pandemic was like QE on steroids.
Absolutely.
They just pumped a huge amount in. So we know we've got too much money out there. M1, I've seen you show the chart of M1, how it increased by 500% during the pandemic. What this chart now shows is that the Fed's tapering initiatives are also working. The Fed is reversing that. They're destroying money, just like they created it and put it into our economy. They've spent the last 2 years destroying it, literally to try and lessen the inflation pressures. And that's the underlying cause. And I think this chart shows they've been very effective.
Yeah.
Their balance sheet went to $9 trillion, and we're now down below 7. I mean, the Fed is still the largest holder of bonds in the world. The Fed owns more bonds than anybody else. But at least the amount of money that they've got committed and the amount of capital and the amount of money in our economy is starting to diminish. So the Fed's on par between now and February. They're going to continue to destroy $60 billion a month is their commitment to us. So we should see that balance sheet, the amount of holdings the Fed have, continue to drop down. And what happens after February? That's obviously going to be some other administration's problem.
Yeah.
That's not Powell's problem anymore.
Is there, in that chart that I've got up here, is there a target in your opinion? I mean, to me, from a technical perspective, it looks like the origin of what we have back in 2020, right around 4 trillion. But I mean, have they been public about where they expect to get this?
No, that's a great question. And I really think it's going to rely on just how much this cash flow is reflected in inflation. If inflation does get itself tamed down to the 2% where the Fed would like to see it, I think they would stop doing the tapering, even if the number is still above 2020 levels. I think it's going to be based on the inflation rate, not necessarily a magic target for the balance sheet. Good question, though.
Well, our core PCE number that came out on Thursday was showing an increase, right? Went from 0.2 to 0.3, and that, let's see if I can bring it up here for everybody to view, but and 0.3 is not a giant number by any stretch, but notice that we were down at 0 in April, we were at 0.1 in May, 0.2 in June, And now we're at 0.3 for our July reading. So, this does show a pretty clear trend. And to be fair, I like to be transparent when I'm wrong. When we go back here to this, if I move this chart over and you look at what happened from December of 2024, we had a similar escalation. We were going about 0.1% per month. And I was like, shoot, at this rate, we'll be at 0.8 by August or September of this year. And I was like, oh, that was going to be really bad. And all of a sudden we went from 0.4 to 0. And now we're stair-stepping up again. So we are showing an increase, but it's nothing that's so catastrophic that's going to derail the economy. But you mentioned something earlier, the dreaded S word, which is stagflation. We know stagflation is rising inflation that is going to be rising unemployment and slowing GDP. And the numbers that came out today from a jobs perspective and the revisions of those jobs numbers for the past couple months, I think was really the big shocker, which of course you had, President Trump now basically saying, I'm going to fire the chairman of the Bureau of Labor Statistics. He did.
Fired him. He did. Yeah.
You're not doing what I want. Get out.
You're not delivering the message. Shoot the messenger.
Yeah. But those numbers were dramatically different, and I think it revised. Unfortunately, I had a really cool chart here of those numbers. Let me show you some of the jobs data today. You look at the unemployment rate, everybody. It was in line with expectations at 4.2%. So things really don't look that bad. It's really
but it's up from 4.1.
Correct. Yeah, but the chart I show here basically is showing we're pretty much sideways since April of 2024. Like we're just chopping sideways, averaging 4.1 to 4.2. So it's not like we're in deep doo-doo.
Absolutely.
Now you look at this non-farm employment change, and a lot of people were talking about this number today. I thought this was rather comical because the expectations were we're going to get 106,000. We were 14,000. They thought we'd get 106. We came out at 73. Well, it's not atrocious, but remember, the trend is your friend until the bend at the end, and it looks like it's cooling off. That jobs market is starting to cool off, which leads me to believe that even though we got 4.2 today, our next month reading will probably be 4.3 to 4.4 because this number is quickly declining, and I think it's going to end up catching up with the markets. I don't know. Am I out of line here? What do you think, Bill?
Oh, I 100% agree with you. And by way of supporting your argument, the two dissenting voters to the policies of the Fed this week were specifically identified the weakening job market as the reason for motivation to show the economy is weak and we need to cut rates.
Yeah.
So, a continuation of these type of numbers would absolutely support a cut in rates. And, even this number today is supporting a cut in rates. If we look before today, the futures market was pricing in a probability of less than 40% that the Fed would cut rates in September. Now, as a result of this one number, just this and the revisions, but as a result of today's data, the futures markets are now pricing an 80%.
88
probability
as of right now.
Oh, 88. Thank you. I've been in class all day.
Hey, 8% does make a big difference. Yeah, 88. I mean, but we've been talking about that here. Like you remain data dependent, and at some point really felt that they were going to probably cut rates, but September seems like the logical point. But remember, we have more inflationary data. We have more jobs data coming out. We have more GDP data coming out in the next month. So.
We've still got a month's worth of data. Look at what one number did.
Right.
And one number is not going to set policy. What I really think we're getting into, and I think today helps show it, we're going to get so data determinant because everybody is now focused on this stagflation issue that we're going to see increased volatility here. I think today is an illustration that we're going to start living number to number. And policy shouldn't be based on just one number.
Yeah.
But to go to it, but I would remind you, this is a pretty inaccurate barometer because the what we're just quoting there of going from 40 to 80%, that's also the same data service that predicted we'd have 5 cuts in 2025.
Yeah.
So at one point.
You never trust it.
Markets change a lot.
That's
exactly.
Right. Absolutely. Well, if we look at what the markets did, you guys might remember over the past couple of weeks we've been talking about this August 1st deadline and maybe some of the shock and awe that President Trump would do. And we expected there to be a sell-off going into that. And, we had a pretty big 2-day sell-off here for those of you who are paying attention. If you go from where we opened up on Thursday to where we closed at today, you had the S&P down, not that number. S&P was down 2.66% from Thursday's open to today's close, and coming right into that August 1st deadline for tariffs, which of course we slapped 35% on Canada today. We'll see how that one transpires. Now, you had another chart on here. I want to bring this one up too, which was showing the the actual Fed funds history. Now, I love this chart because I think it speaks volumes to expectations versus reality. Like right now, we've had this monstrous surge up in rates. And now we're starting to see some drift down. You can see it kind of tapering down on the right-hand side, the very hard red edge. But, it goes right back up to those highs we had in 2008, 7 and 8. We're right to almost the same number. From a long-term perspective, this doesn't seem like it's that bad.
Well, and that's kind of the discussion that often happens when I show this chart, because what honestly precipitated me producing this chart and showing it in my classes is I've heard the constant phrase over the last year that, the Fed funds rate needs to be brought down. We now have the highest Fed funds rate in 23 years. And, like that's some sort of magic number. And what this chart shows you is, yes, that is true. If you look at the 5.25% that we hit, that is the highest Fed funds rate in 23 years. But I would have to remind people that there were two extraordinary events during that period of time. One was the Great Recession, where from 2008 through 2013, the Fed orchestrated rates lower because we had the Great Recession. And then the pandemic, where again, we brought rates down to zero for a protracted period of time. So this was a pretty calamitous 20-year period.
Yeah.
What I like about this chart is it shows you a greater depth of time. Go back to the 1980 period that we were talking about just a moment ago with Paul Volcker. I mean, that's not a misprint. That's a 20% Fed funds rate.
Yeah.
It costs the banks 20% to borrow money.
Crazy.
In this environment, 4.25% doesn't seem all that high to me. So I just wanted to give it a little bit more historical context.
No, I love it. The thing that gets me is that if you guys focus here on the 2010 part, really from 2009 when we had our financial crisis in the U.S., those rates got slashed all the way down to pretty much zero. But notice how long it stayed there. I mean, this is like your pedal is to the metal. You can't go any lower. You are just stuck at zero, free, cheap, easy money. So I've had friends and people question, this market rally. Well, it's hard not to have a colossal market rally when basically money is free. And they were handing it out to you and I as citizens. They were handing it out to businesses with these, non-repayable loans, which in my language, that's called a gift.
That's right.
I feel like I'm a little bit sad with myself, Bill, because I have a moral compass and I do have a business, and I could have easily qualified for some of these loans and just taken free money, as a lot of people have done. And to me, that really, I don't know, it abuses the system. It takes away from you and I, the taxpayers. But hopefully, the government can crack down on those. It was what?
It was abused. It was abused.
Yeah.
You're right.
There's people here left and right. They're getting arrested in Southern California because they just bought Lamborghinis and houses with it. It's like, man, you're supposed to stay alive, but. I couldn't do that. But yeah, non-repayable loan. I should have signed up for those, as many as I could get.
That's a gift.
That's a gift.
While we've got this chart on there, maybe if I could show you the group. I've expressed probably too much. Having lived through that period as a bond person, I was first in the market in 77, so I caught the end of the Volcker years. I do worry about inflation. I worry about it here today. And if you look at this chart, look where inflation was in 1988. Where the Fed funds rate, not inflation, the Fed funds rate hit almost 20%. If you go back just 3 years before that, the Fed funds rate was at 5%.
Yeah.
Right where it is today.
Yep.
We went from 5% to 20% in a 3-year period of time. When inflation rears its ugly head, it can be ugly.
Do you think that this is a tough question. Do you think that any central banker today, whether it's currently there or appointed by Trump, is going to have the stones, well, if they're female, we'll just say have the chutzpah, to do something that dramatic? Like, I just can't imagine in this day and age someone saying, yeah, we're pushing rates up to 17, 18, 19%. I just don't see that happening.
No, I don't see anybody having the fortitude for that. And again, Volcker had the beauty of being able to do it behind a curtain. The market didn't see what he was doing when he was doing it, because the Fed didn't make any announcements. So, they raised the Fed funds rate 700 basis points. It took 2 months for that to happen and 2 months for us to figure out what was going on. Yeah. In today's world, with the Fed making an announcement, could you imagine if Powell got up there and said, we just made a decision to raise the Fed funds rate by 7%? There would be such a crisis of confidence in the U.S. dollar. I mean, the dollar would plummet. I mean, it would be horrendous.
I think our financial system today, Bill, is so much more transparent
Yep.
overall, from whether it's
Yep.
equities, bonds, policy, all that stuff seems so much more transparent that when Volcker raised it 700 basis points, the market kind of absorbed it. I think if it happened today, all proverbial hell would break loose. Like these markets, I mean, I don't know whether you'd see a 3,000 move up in the S&P or down in the S&P. I just know it would be just chaotic.
Yep.
Let's hope it doesn't happen.
Yeah, no, I don't want to have to portend that. So, no, I don't think the system would even allow for it, basically, in today's world.
Yeah, Steve says ES would be limit down. Not only would ES be limit down, but remember, there's 3 circuit breakers, right? So it would probably lock limit down for the day, which I believe it's 21% is the ultimate lockdown for a day, and it can't move any further.
Is that what it is? I forget.
Yeah, it would be pretty bad, but I doubt that's going to happen. I mean, we had a pretty ugly day today. I can run through some of the numbers here for the viewers. You had your S&P was down 1.7%, and just a brutal candle today. Nasdaq as well down 2.06. Amazon, take a peek at AMZN today. Amazon down 8%. I'm looking at this going, I think Amazon's going to be a buy here at some point, but I'm going to wait till next week to see. But pretty much everything across the board looking pretty beaten down today. Even your 10-year yield, which I think does a lot with, forecasting the Fed funds rate. Of course, that doesn't directly impact the 10 because, Feds is the short end of the yield curve. But you saw a significant decline today in the yield. I mean, it was only 16 basis points, but still an intraday move of 16 basis points for the 10-year is significant without a major event happening. We're at 4.2 right now on that one.
And I would also point out there was even more volatility in the short end of the yield curve,
Yeah.
which are normally more stable. The 2-year yield went down by 22 basis points today, which is basically pricing in a quarter point cut.
Exactly.
The shorter the maturity, the more it's going to correspond directly to what the Fed does. As you said, the 10-year, not a great correlation to what Fed policy is. The 2-year is much more direct because it's the shorter maturity closer to the Fed funds rate. So that going down by 22 basis points, that just priced in a quarter point cut right there in one day. But again, I got to stress, one day's numbers should not determine policy.
Right.
Let's not get ahead of ourselves here.
100%. Yeah, I'm definitely in that camp. And on this program, I'm trying to read the news and data as it comes out. But yeah, just because you had a non-farm employment change today that was not favorable, I mean, that doesn't mean it's the end of the end. And of course, having Jerome Powell or President Trump fire the Bureau of Labor Statistics commissioner, that was pretty knee-jerk move, but is what it is. We'll see what happens next month. I think that's a big telltale. From a stagflation perspective, we've talked about obviously the inflation side of things. Is there anything there you want to add to on that inflation? I know you had a graphic showing PPI versus core PCE price index, which is significantly different.
Yeah, the only thing and you're going to draw that slide up. I'll explain why I sent that just in case, because I have been very impressed by the economic acumen of your audience. I get really good questions from your group. And I just came off of a focus class today. I was together all day today with a group. And, inflation is obviously, well, actually, if you don't mind, I'm going to take a step back even further, just so that everyone's comfortable with this idea that what I'm worried about and what we're worrying about as we're talking about is the concept of stagflation. If I could just for 30 seconds explain what that is and why it's a problem. Because stagflation is when you have rising inflationary pressures, but weakening economy.
Right.
See, those two things, as you know, I'm talking to you, but I'm talking to the audience because I know you know this, but, normally those things don't go together.
Yeah.
Normally it's a strong economy that causes inflation, or a weak economy causes deflation. We've got a misjoint here. We've got rising inflation without a rising economy. And the real problem is the Fed doesn't know how to respond to that. Because what should we do? If we're worried about inflation, then we should raise interest rates. But if we raise interest rates, that's going to further hurt the economy, which is already in trouble.
But hold on a second, Bill. The economy is not one of the dual mandates.
Employment. Let me use that as a proxy.
Okay. I know.
You're right, though. Yeah,
I joke because we all know that it is implied that that's their third mandate is to make sure the economy is okay. I just joke.
Exactly. So the Fed gets put in a damned if you do, damned if you don't situation. And that's why I really do believe that Powell is dragging his feet as much as he is. And I'll admit, he's hardly being proactive here.
Yeah.
But he is responding to looking for a clear signal. What should we be responding to? If you look at the numbers from the economy, obviously the economy is a problem. Mm-hmm. Maybe we should respond to that and cut rates. But yet the week before, we had both CPI and PCE higher than expected.
Right.
Maybe inflation's a problem. Maybe we should raise rates. I mean, literally, they're in a quandary here. So Powell is looking for clear direction. And then, without getting political, add on top of it the tariff situation.
Right.
Most economists would acknowledge there's going to be some upward pressure to inflation when these tariffs are finally implemented. Finally, let's get it done with. But how much we don't know. This is unprecedented.
Right.
So add on top of it the fear of inflation. I understand why Powell's being reticent.
Yeah, I'm with you, and I've been kind of emphasizing. Well, we as a group have been emphasizing that. It's not just me; like a lot of the audience believes that as well. Is he's doing a good job, and to hear people like Senator Lummis and Powell and others just outright attack him, saying he's incompetent, he's not doing a good job, he deserves to be fired. And it was like, hold on a second, you can't point a finger at someone who has bailed out the economy, managed to give us a soft landing because it could have been much worse, and now that it's not doing exactly what you want to do, you throw him under the bus. Like, he should be waiting, right? You're right. You've got unemployment is slowly creeping up. So from an unemployment perspective, I don't think raising lower rates really makes a big difference to the unemployment rate. Inflation, when you have these variables like Canada tariffs, Mexico tariffs, China tariffs, and others that have not been resolved yet, those are such massive wild cards to the economy. You have to be patient and wait till that's done. And if we came out today and we heard that Canada was a locked signed deal, Mexico was a signed deal, and China was a signed deal, and we don't have any major issues with our major trade partners with regards to tariff, that's removed, and we can now predict the impacts, then Powell will absolutely cut in September, right? Because you can now predict those elements of inflationary pressure, whereas right now we don't have a damn clue.
Yeah, exactly. It's a moving target still. So how can you make policy on a moving target? I don't understand it.
Yeah, well, I certainly would not want to be in Powell's shoes, and I wouldn't mind his paycheck. Probably not too bad, and especially when he's done with this, he's going to do some speaking engagements to get paid a ton of money, have somebody write his book for him, and
exactly. The other thing the only other thing I was going to say is that in regards to Powell, and I will admit, and due disclosure, the Fed is a client of mine. I train at the Fed. But I do think that Powell is entitled not just to keep his job, but he gets to deserve to take a bow.
A statue.
Because he got us out of the inverted yield curve without a recession. We got the soft landing.
Yeah.
That's never happened in history before. Every time the market went inverted, the Fed pushed us into the recession. Powell's Fed did not push us into recession.
Yeah.
So I think they're entitled to actually take a victory lap. I don't think that's ever going to happen. But I really, and we've had this discussion before, I think they did a great job of bringing inflation under control without pushing us into recession. Never been done before.
Yeah, pretty impressive. Going back to the 10-year yield here, you and I have kind of both been in this camp of feeling that those yields are going to be rising. And mainly because we've got this ever-increasing debt. It seems like internationally, with the tariff wars and all our rhetoric with other countries, we're making more enemies than friends, which would cause some people to maybe not buy our debt. And, you use the U.S. dollars, world reserve currency. We've been chopping sideways since mid-April. Like, it's really just been oscillating right around that 4.35 mark. We're slightly below that now. But it really has done nothing for the better part of 6-7 months now. Do you still hold on to that belief that these rates are going to go higher, or is there something that Bessent and Powell or the economy has done to warrant lower yields on that 10-year?
No, that's a great question, and there's a variable aspect to this that I also should point out is, the government is selling as much long-term treasuries as they ever have. The deficit is not under control. We have a lot of maturing treasuries, so we know we're getting hit with a boatload of supply. And that normally would provide upward pressure to interest rates because, think of it like the government has to compete with itself when it keeps bringing more and more treasuries to find an attractive yield. So all of this supply should be resulting in higher yields. And in fact, we're not seeing that. And counterintuitively, we're actually seeing strong demand for treasuries. And I'll confess, I am, and many others, are hard-pressed to say why.
Yeah.
When we look at the last 10-year and 20-year, not 20-year, 10-year and 30-year auctions that we had last month, we had unprecedented demand for those treasuries. I mean, we had 2.7 times bid to cover ratio on the 10-year, almost 2 3/4 times more buy orders than we had treasuries. And a lot of that buy interest was coming from overseas.
Yeah.
That's the real paradox to me. The foreign participation in the 10-year last month versus the month before was up by 62%. So the foreign market is stepping up to buy treasuries. And I have to be honest with you, I'm not sure why.
No, it's probably because they're offering such a high yield, and we're not going to default at least anytime soon.
Yeah, or maybe it's a function they're more worried about their local
Their
economies.
local economy, yeah.
You couldn't, when you're the best of a bunch of sinking ships, you look good. Maybe it's just a reflection of what they feel locally.
What's your thoughts? I don't know if you and I have discussed this. We've discussed with the audience here a bit, but the Genius Act and what the Genius Act did from a short-term Treasury perspective. It's now mandating that all of these stable coins, if you want to issue it in the United States, you must buy only one of three things. You've got cash on hand deposited in a major financial institution in the U.S. You can be part of the repo market, or you can have short-term treasuries, 93-day maturity or less. This to me is fantastic. I mean, well, let me not put words in your mouth, but what are your thoughts on creating an environment that forces anybody who creates a stablecoin, and it's a huge potential market here. You even heard Jamie Dimon on TV yesterday saying, huge fan of stablecoins and what it's doing for money transmitting. What do you think the impact might be for our bond markets with those?
Well, I think first off, on a couple of different levels, I love stablecoin myself because I have been a critic of Bitcoin because it's not a coin.
You still are a critic.
There's no currency aspect to it. What's that?
You still are a critic.
I still am a critic, exactly. But stablecoin addresses that. That evolves the product into truly becoming a currency. So I love that. I also love the fact that they've qualified what being insured or backed means.
Yeah.
Remember Tether when they went under and they had a stable coin and it was supposedly backed, but it was backed by a portfolio of derivatives? It wasn't actually backed by bonds.
Well, they didn't go under, but they still have that portfolio. They've got gold and Bitcoin and corporate junk bonds in there. Yeah.
That's not a backed portfolio. That's a market risk portfolio.
Right.
So I like the fact they've been much more determined in what exactly it means and owning treasuries and cash.
Yeah.
So from a selfish point of view, being a bond guy, the reason I like it is the one you've been promoting is the fact that it's going to increase demand for treasuries. If all of these issuers have to securitize by owning treasuries, there's a market for treasuries that doesn't exist now. So I love the idea. Anything we can do to increase demand for treasuries, I'm in favor of.
Right.
And the $64,000 question is, and you've probably seen projections, I'll be honest with you, I have not. How big do they estimate this market could get?
Multi-trillions.
Yeah, that's what I would expect.
Multi-trillions.
Now, realize we don't necessarily have multi-trillions of dollars of treasuries with a maturity of less than 91 days. What are we going to do in that case?
They could start issuing more.
You think the Treasury is going to issue more just to appeal to this one client base?
They'll issue more, and they'll drop that yield even more because then they can get that money cheaper. Right? So let's say right now you're at 4.1, 4.2%. If demand so far outstrips supply, then the Treasury's going to go, well, shit, let's just issue more of it, and we'll drop that yield from 4.1% to 3.5 to 2 to 1, and maybe gets down to 0.5%. Doesn't matter what that yield is. These stablecoins are obligated under the letter of the law now to buy Treasuries. So they're going to buy it no matter what the yield is.
I'm not sure the Treasury would adjust to one client like that.
Well, it's not one client. Remember, it's not one client.
Well, it's a client base of stablecoin issuers.
But that client base could be Tether, could be it. It could be the Bank of Japan. It could be Amazon.
It could be a variety of different issuers, of course. Yeah, no, I understand there's a variety of different issuers. But the point is they are all stablecoin issuers. That's who's going to be buying these treasuries.
Yep.
And the government claims they don't play that supply and demand game. It's back like when the Fed brought interest rates down to 2% for 30 years.
Yeah.
I mean, an absurdly low interest rate. Logic would say, my God, load up on 30-year treasuries. The government. Start issuing 30-year bonds because we can finance the government for the next 30 years at only 2%. That was crazy. They didn't do that.
Yeah.
They continued to issue a linear amount of treasuries across the maturity spectrum. So if they do actually adjust the offerings that they make to appeal to a group of investors, large as they are, and I admit they're going to be large, that would be the first time we've ever seen that. I'd be interested to see if they're really willing to do
Yeah.
that.
Well, time will tell. I think we're going to get to that
Yeah.
point. Real quick, I realize that the time's running late here, and I've been
Yeah.
given my mindset over the past couple weeks and all the garbage that's been going on with me. My shows have been the shortest they've ever been, which has been great. I've enjoyed doing shorter shows. You talked before the program about the DTCC, and that is basically a government-sponsored entity that is responsible for custodying all the securities in the U.S. And you talk
every single equity.
every single. You think it's at your Schwab account? It's not. The Schwab has a little IOU from the DTCC that your shares are there. Now, there has been documented, you can go look it up, evidence of accounting irregularities, of errors being made by the DTCC with regards to inventory control and where all those shares are. You mentioned they're talking about tokenization and real-world assets, which Larry Fink of BlackRock has also said they are all in. And you made it sound like the DTCC is saying we're all in on it too. So maybe you can shed some light on that one.
Yeah, thank you. DTC, again, is a client of mine, and I've spent a good amount of time with them over the last month, and I've really had a chance to see what their expanding operations are in the crypto world. Now, when I say crypto world, everyone immediately thinks the currencies. And that's not necessarily where the development is. So DTCC, just for your audience to explain, every one of your clients, I guarantee you, has done business with DTCC on a regular basis because they are the clearinghouse for every single equity trade done in the U.S. on an exchange. When you buy or sell a stock through your broker down on an exchange, DTCC is actually put in the middle of that trade. You're actually selling it to DTCC, who's selling it to whoever's the buyer on the other side. They are the counterparty to every single equity trade done in the U.S. on every exchange. They also, as you were expressing, are the depository for all these shares. There's tens of trillions of dollars of shares outstanding. And a lot of that is still in the form of paper, believe it or not. But where is that paper being warehoused is in this organization, DTCC. So their functionality in the securities industry is huge. I mean, they have huge impact. And what they are starting to do is to incorporate blockchain technology into their businesses. So, for example, in products we don't talk about a lot, but we have a product called the repo market, which is the largest trading market in the US, and also in a derivative product called swaps. DTCC is now providing clearing services in those products. And then that means, again, they get in the middle. So when Goldman does a trade with Citibank, DTCC swaps is in the middle. And they are clearing all of that business using blockchain technology, all of it. I mean, they're doing anywhere between $4 and $7 trillion a day in transactions that are supported by blockchain.
It's awesome.
And that's been going on. Oh, it's amazing. And it's provided for great operational efficiencies. I mean, it's just incredible how much spare capacity they have as a result of this transition. But what we were talking about, and that was more background. What DTCC is also getting involved in is tokenizing of securities. So literally, they have been working with 26 different bond dealers, and they've now done hundreds of trades in the bond market where they take an individual bond transaction and turn it into a token and literally tokenize that market. And I have to confess to you, I was really in a quandary at first. What's the benefit of this? I mean, I know enough to be dangerous. What's the benefit of creating a token out of this transaction? And a lot of it has to do with bankruptcy laws. And not to get too nerdy, but take an organization like Goldman Sachs. They've got billions of dollars worth of treasuries that they own. They're a primary dealer, but they also use their treasuries as collateral for a lot of different transactions. They deposit treasuries with the Fed. They deposit treasuries with the futures exchanges. They deposit treasuries with DTCC. I mean, they're lending out treasuries all over the place as collateral to support their different businesses. And keeping track of that collateral is starting to get somewhat problematic. So by moving these treasuries onto a blockchain technology and tokenizing it, we can better facilitate the transfer of these from one firm to the other. But you also, and you're more familiar with this than I am, Merlin, is we can do smart contracting. We can create tokens where there's triggers in it. There's bells and whistles, where if something happens, something else will happen. So, for example, I'm using collateral, treasuries as collateral. I've got them on deposit at DTCC, and I go bankrupt. I'm Goldman Sachs, I go bankrupt. Well, that collateral will automatically revert over to DTCC
Yep.
because of the trigger that's been built into it, as opposed to having to go to the bankruptcy courts. Who's going to claim this collateral? Who's going to claim that collateral? So it really does create, I hope I've done an adequate job of explaining it, some great operational efficiencies, particularly in the event of a credit event, a downgrade, or a bankruptcy, where the collateral could have to change.
Yeah, there's a ton of positive things that could come of this, and I think one of the great things is transparency and accountability. Now, the question's asked which blockchain. I believe they use it's an app on Ethereum, so they're using the Ethereum mainnet, but it's called Besu, which is a specific application, proprietary application used exclusively by the DTCC, but it plugs into Ethereum blockchain. So when you talk about, which blockchain should you be looking at, this is another notch in the cap of Ethereum from a utility perspective. So yeah, Ethereum, if Margaret, you already own Ethereum, so there you go. But this should help the efficiency, transparency of our financial system. But keep in mind that this is the custodian of all of these shares. What you're probably going to see within the next few years is every major financial institution, Schwab, Fidelity, Goldman, all plugging into these existing networks. And from my perspective, what that means is the growth of cryptocurrency and digital assets ecosystem becomes much more substantial down the road.
Yep. And DTCC is also looking to increase their role, perhaps as a clearinghouse in some of these products.
Yep.
Where they can take the credit risk and take on that risk as well. So they're looking to expand their business model from just equities and bonds into the crypto world. And thanks to their use of blockchain technology, they've really got a market edge here. Yeah. I was very impressed by how much transactions they're doing.
I love it. And you know what? Not only do I love when you come on the show because you're just a great person, a good friend of mine, but also you share some great knowledge. And this is cutting edge stuff. I think, no offense, but I think when people see Bill Addiss in the show, like, oh, here's this old guy, what does he know? He doesn't know any new technology. Well, the stuff you just mentioned is so cutting edge. I mean, it is really shaping the financial system. So thank you for sharing that with the audience. I appreciate that. Tell me your schedule as we wind down here. What's your teaching schedule look like?
Yeah, I'm just finishing up with my summer craziness. With Wall Street hires this army of talent, and I get to work with them. So we hit about 2,500 new hirees. I'll be doing that for the next 3 weeks. Couple more programs to go. So I'll be on the road for 3 weeks, and then things do settle down. I just did the one-day focus class. We have a one-day fixed income class we run every 6 weeks. I conducted that. That's why my voice is a little hoarse today. Sorry. But we had a good day of fixed income, and that runs every 6 weeks. And my next XLT with this group is going to be on August 20th, and we're really going to focus on fixed income ETFs. People are much more comfortable with equity ETFs, but I want them to understand the trading opportunities with a basket of securities. So we're going to focus on the ETF world, both sovereign ETFs as well as credit. Corporate bond ETFs, muni bond ETFs. How do you compare them? How do you decide who's doing a better job? So it's going to be fixed income ETFs on August 20th.
Nice. I'm going to share your calendar. You guys see his calendar here. Basically, his Friday sessions is when he does his focus class, which is bonds and markets, canary in the coal mine. He has application sessions, as you saw here today. He just finished his bonds class, so that's the full all-day one. But the way the focus programs work at Trading Academy is you get a full all-day class, and then there's application sessions. So you can see these 4 here running out the rest of August. And here's his XLT general session on the 20th. For those of you who are Trading Academy students, you can just log into your portal, go to the calendar, type in the name of the instructor or whoever you'd like to see, and there you'll find their schedule. So. Well, Bill.
Perfect.
Thank you, man.
Always
I appreciate it.
Mr. Merlin.
Always
a pleasure.
Always a pleasure. Go soothe your throat. Go have something nice to drink. I hope that you have a fantastic weekend. So cheers to you, my friend. I appreciate you for everything that you do. And I hope you get out here on the West Coast soon so we can catch up on some of those beers you owe me.
I hope so too. You're 3 up on me. I owe you. I got to pay, or I'll be called a deadbeat.
That's it. So, I had to make do on my debt with Big Ed. We drove like 45 minutes each just to make it happen. But maybe we'll meet in the middle of the country. We'll go to like Denver or something. I'm just kidding.
Sounds good. We'll work something out.
Sounds good.
I like the fact that Big Ed paid you up. Paid up. So
I paid him. I owed him. Yeah. I'm the loser with that one.
Oh, sorry.
No,
okay.
It's all good.
Backwards.
No problem.
Enjoy your weekend, and my best to everybody out there.
You too. Take care, Bill.
Be well. Thanks, Ken.
Guys, that was Bill Addiss, our resident bond expert. You can find out more information about his Canary in the Coal Mine program by visiting Trading Academy. He's always got so much good stuff to talk about, and just experience, knowledge, and to me is power all around. All right, I didn't realize how late it is, so I'm just going to run through these markets real quick and give my little 2 cents on them, and then I'm going to wrap up and hopefully go enjoy a good weekend. We already talked about that 10-year yield, pretty significant decline. Look, if you are bullish on the economy and bullish on the markets, you want this thing to keep on tanking. You'd love to see it keep on dropping because that means the housing market might tick back up, which is good. Your bad news is this bad boy right here. We talked about that yellow box on Bitcoin and saying how critical it really needs to stay above 115,635. Well, not only did we break that today, but we screamed lower. We were down 3.29%, 113,570 is where Bitcoin closed at. This is not good. This leads me to believe that if that momentum does continue and liquidations of leveraged longs happens, remember we talked about liquidations of the leveraged shorts, that's what's caused the big moves up. This could potentially get down to about that 107.5 mark. I'll even draw a little yellow box there. I don't want to see that, but that's just what the charts are telling me, and I really would not be happy to see that. But hey, markets are going to do what you at least expect. That would bring us down to about 107.6 to 109. That seems like a fairly logical price point. So hopefully we don't get down there. I'm getting murdered on my MicroStrategy. So here's my MicroStrategy today. I'm getting beat up on this one. I had the 385 puts as well, so I'll be executed at 385 on that bad boy, and I'll be underwater on that come Monday morning. We'll have to see how to do damage control there. Crude oil. 2.79% slide. It actually looked like things were turning the corner as we're making this new higher high here on Wednesday and Thursday, but giving back most of those gains today. So all in all, I still think we have to look at this lower demand zone as respect at 64.60 to 65.46. Russell 2000 taking a bit of a dive as well, down 2.12%. This one, just like Bitcoin, broke below some key levels. And, from my perspective, it looks like that's going to keep on drifting lower and lower. Just the emotions are there, right? We're getting some bad economic data and you got feuding and unemployment, all that stuff. It's not looking that great. NASDAQ, just look at those 2 red candles. It's crazy. They're the 2 biggest red candles on the screen, and they're back to back after this gigantic bull market rally, which we've been talking about. We talked about going short if we get a close below 23,421, and unfortunately that happened on Thursday, and I was not there to have played that one. So unfortunately, no trades for me. Actually, this is a pretty big loss week for me, but we'll do damage control and make it work. Here is your S&P 500, also down 1.72%. I think it's kind of important that it stops right here. 6,246 on that futures is right where it's at, and you can see that sideways consolidation for pretty much all of June was right there. July was right there as well. So hopefully that holds. If not, I think you're stair stepping down to 61.44 on the S&P, and that would not be a good thing. Dollar index down 1.33%. Talk about an about face, right? We finally broke through. We're breaking through these shorter term pivot highs. Ripped through, looked great, and all of a sudden it felt like a bear or a bull trap today. I just came screaming back down on that dollar index. And finally, gold. People freaking out a little bit, tariffs and uncertainty. Let's run to gold. We had a 1.53% gain for gold today, 3,399. And that, my friends, is pretty much it. So I'm going to wrap it up there. I appreciate you guys asking me about Bill Addiss and having him on the program. It was great to have him on the program. I loved it. Irish, good to see you as well. And, we went to a memorial service yesterday for Arthur Evans, which was really nice. It was just great to see, so many people supporting Arthur and just remembering good people. And, in closing, I will say, one of the things that has been helping me with this therapy that I'm doing and connecting with my emotions, and those that don't know me know I'm very closed off emotionally, is, the way that this thing happened with Arthur, it was so sudden, it was so out of nowhere that it catches you off guard. And one of the regrets that you have in a situation like that is you didn't get a chance to say goodbye, which you never want to say goodbye. But more importantly, you didn't get a chance to tell that person how you feel about him. So the last couple of days have been very interesting for me, especially one of the things I think that ruined my previous relationship was my lack of openness, my lack of expressing emotions, which, unfortunately, there's no going back for that now. But going forward, I actually did something last couple of days, which is calling a lot of my really good friends who I now don't really stay in touch with much, but they're, core people in my lives, and just telling them how much they mean to me, how special they are, and hopefully you guys all do that too. Think about people that are important in your life and tell them what they mean to you, because you never know. Could be like Arthur Evans and just snap your fingers and they're gone. So hope you guys have a great weekend. Cheers, everybody. Big Eb, thank you very much for the McKenna 10. I'm going to go have another couple glasses of this and drown my sorrows and hopefully have a fantastic weekend. I hope you guys all do as well. So Call your family and friends. Tell them you love them because I'm sure they'd love to hear it. Have a great weekend. I'll see you Monday.